Today we will talk about most popular methods of valuing companies in value investing strategy. Value investing, or the search for undervalued stocks relative to their true intrinsic value, is one of the most popular and effective investment strategies. The key to success in this method is proper company valuation. In this material, I will discuss the 3 most commonly used valuation methods, point out online tools for analysis, and provide examples of their practical application over the long term. Finally, I will suggest which method is best for beginners and which one advanced investors should consider. Of course, these are just sample valuation methods. There are many other techniques or combinations of them, but today I would like to present the most well-known and widely used ones. Let's get started. 1. Book value method, price-to-book ratio, P/B. The price-to-book ratio is one of the simplest methods for valuing a company, comparing the market price of the stock to the book value per share. Book value is the difference between a company's assets and liabilities, in other words, the company's net worth. Arguments in favor. Simple to calculate and intuitive. Excellent for evaluating companies with significant tangible assets, e.g., banks, industrial companies. Helps find companies that the market has significantly undervalued, especially during crises. Online tools. Yahoo Finance, finance.yahoo.com. The statistics section contains the P/B ratio for most companies. Morningstar, morningstar.com. Detailed book value data for companies. GuruFocus, gurufocus.com. A platform dedicated to value investors with the ability to compare P/B ratios between companies. Practical application. Research conducted by Professor Joseph Piotrowski in 2000 showed that investing in companies with low P/B ratios and strong financial indicators yielded an average annual return of 23% over 20 years. This strategy was particularly effective in evaluating small and mid-cap companies. 2. Price-to-earnings ratio, price-to-earnings ratio, P/E. The price-to-earnings ratio measures how much investors are willing to pay for each dollar of earnings generated by a company. It is one of the most well-known and widely used indicators in investing. Arguments in favor. Easy to compare companies within the same industry. Allows quick identification of cheap or expensive stocks. Ideal for evaluating companies with stable earnings. Online tools. Finviz, finviz.com. Free access to P/E ratio data for many companies. Zacks Investment Research, zacks.com. Detailed fundamental analysis, including P/E ratio. Simply Wall Street, simplywall.st. Visual representation of valuations based on P/E ratios. Practical application. Companies with low P/E ratios have proven to be very profitable in studies conducted by Nobel laureate Robert Shiller. His analysis showed that investing in stocks with the lowest P/E ratios yielded an average annual return of 16% over 10 years, compared to 10% return from the S&P 500 index. 3. Discounted cash flow method, discounted cash flow, DCF. DCF is a more advanced method that involves estimating the value of future cash flows generated by a company and discounting them to the present value. It is a comprehensive tool that assesses the true value of a company based on its ability to generate cash. The formula for calculating the value of a company using the DCF method is quite complex. Below, I will present its structure, however, we will not discuss it in detail in this material. Arguments in favor. the most precise method, considering the company's potential growth. Useful for valuing technology companies and other fast-growing firms. Allows for comparison of intrinsic value with market price. Online tools. Simply Wall Street, simplywall.st, offers automatic DCF analyses for hundreds of companies. Investing.com, investing.com, advanced tools for conducting your own DCF analysis. StockRover, stockrover.com, a platform for advanced investors, including DCF tools. Practical application. Research conducted by Michael Mauboussin from Credit Suisse showed that well-executed DCF analysis achieved stable annual returns of 12 to 15% over 15 years, outperforming the S&P 500 during periods of high market volatility. Which method to choose? For beginner investors, a recommended method is the price-to-earnings ratio P/E. The P/E ratio is simple to calculate and easy to understand. It allows beginner investors to compare companies within the same industry and assess whether stocks are cheap or expensive. Tools such as Finviz or Zacks make it easier to find companies with low P/E ratios. For advanced investors, a recommended method is the discounted cash flow (DCF) method. DCF requires deeper knowledge and precise forecasts, but it provides the most accurate results. Using a platform like Simply Wall Street can help with more complex calculations. It is the ideal tool for experienced investors who want to conduct in-depth analysis of companies. Understanding company valuation methods is the foundation of value investing. The P/B, P/E ratios, and DCF method offer different approaches that can be adapted to the investor's level of expertise. Regardless of the method chosen, it is crucial to use the right tools and test your assumptions in practice. Success in investing is based on patience, consistency, and continuous improvement of your analytical skills. If you are just starting your investment journey, begin with simpler indicators and gradually learn more advanced methods. Let me know if you use any of the methods presented in your investing today.